Imagine owning a piece of prime real estate without the burden of a huge down payment or a long-term mortgage. That's the power of fractional real estate investing. It allows everyday investors to buy shares in high-value properties, just like buying stocks, making real estate ownership more accessible and flexible. In this video, we'll explore how fractional investing works, its benefits, risks, and whether it's the right strategy for you. Let's dive in. Today we will talk about fractional real estate investing, owning property without a mortgage. So before we start, make sure to hit the like button and subscribe to my channel. 1. Fractional real estate explained. Fractional real estate investing allows individuals to purchase a portion of a property rather than buying the entire asset. This concept is transforming the way people think about property ownership. Traditionally, buying real estate requires significant capital and often involves large mortgage commitments. Fractional ownership, however, lowers the entry barrier, enabling investors to own a slice of high-value properties, such as luxury apartments, commercial buildings, or vacation homes, without the need to secure a mortgage. Investors typically pool their money through a platform or syndication to acquire the property, and their ownership share corresponds to the amount they invest. This approach is increasingly popular with younger investors and those seeking portfolio diversification without being over-leveraged. 2. How fractional ownership works. Fractional real estate investing operates through joint ownership structures, where multiple investors share legal ownership of a property. Each investor's share is typically documented via contracts, shares, or tokens, depending on the platform. For example, if a luxury villa costs $1 million and an investor contributes $100,000, they effectively own 10% of the asset. Ownership can be structured as a tenancy in common, a real estate investment trust (REIT) model, or via tokenized digital assets through blockchain platforms. Many modern fractional platforms offer digital dashboards, allowing investors to track performance, rental income, expenses, and asset appreciation in real time. Most of these properties are professionally managed, relieving investors from the typical landlord responsibilities. 3. Benefits of fractional investing. Fractional real estate investing offers several key advantages that make it highly appealing to modern investors. First, it provides accessibility to properties that would otherwise be unaffordable, such as high-end vacation homes or commercial real estate in prime locations. This allows small investors to diversify their portfolios and tap into potentially higher-yield markets. Second, it reduces risk exposure, as investors can spread their capital across multiple properties or asset classes, minimizing the impact of any single property's downturn. Third, fractional ownership typically comes with professional management, meaning investors are not responsible for maintenance, tenant issues, or legal compliance, which significantly reduces time and stress. Additionally, this investment model often offers passive income through rental yields, allowing investors to earn without active involvement. 4. Potential risks involved. While fractional real estate investing offers numerous advantages, it also comes with distinct risks that potential investors must carefully consider. One major concern is liquidity risk. Unlike stocks, fractional real estate shares can be harder to sell quickly, especially if the platform lacks an active secondary market. Investors might have to wait until the property is sold or the lock-in period ends to liquidate their holdings. Another key risk is market fluctuation. Real estate values can decline, especially in volatile markets or during economic downturns, potentially impacting both the capital investment and rental income streams. There's also platform risk. If the company managing the fractional investments goes out of business, investors may face delays, reduced service quality, or even financial loss. 5. Platforms offering fractional real estate. A growing number of fintech and proptech platforms have emerged to facilitate fractional real estate investing. Companies like Fundrise, Realty Mogul, Orant Homes, Lofty.ai, and Yield Street are leading the charge in the U.S. market, while platforms like BrickSave and Property Partner are popular in international markets. Each platform typically specializes in specific property types, ranging from residential, vacation rentals, and single-family homes to large-scale commercial properties. Some platforms offer blockchain-based tokenization, which allows fractional ownership through digital tokens, enhancing security, transparency, and liquidity. Others focus on crowdfunding models where investors collectively fund property acquisitions. Most platforms provide detailed investment prospectuses, financial projections, expected rental yields, and risk assessments. 6. Key legal and tax considerations. Fractional real estate investing comes with specific legal and tax implications that vary by jurisdiction and investment structure. Investors typically own a legal share of the property through a limited liability company, LLC, special purpose vehicle, SPV, or real estate investment trust, REIT, depending on the platform. This structure protects investors from liabilities beyond their initial investment, but it's essential to fully understand the ownership contract and rights. Tax obligations can be complex, especially for international investors. Rental income is usually taxable in the country where the property is located, and capital gains taxes may apply when shares of the property itself is sold. Some countries also impose withholding taxes on foreign investors, requiring proper tax planning to avoid unexpected liabilities. Investors should also be aware of double taxation treaties that may impact how profits are taxed across borders. 7. Comparing to traditional real estate. When comparing fractional real estate investing to traditional property ownership, several differences stand out. Traditional investing usually requires a large down payment, mortgage approval, and ongoing management responsibilities, such as dealing with tenants, maintenance, and property taxes. In contrast, fractional investing lowers the entry barrier significantly, often requiring much smaller initial investments, with no need for personal financing or mortgages. Traditional real estate provides direct control over the property and decisions related to leasing, renovations, or sale timing, while fractional investing offers little to no control, as most decisions are made by the managing platform. Another key difference is liquidity. Selling a traditional property can take months and involve high transaction costs, whereas fractional platforms sometimes offer secondary markets that facilitate quicker, lower-cost sales of ownership shares. 8. The future of fractional real estate. Fractional real estate investing is poised for significant growth as technology, regulation, and investor preferences continue to evolve. The rise of blockchain technology and asset tokenization is expected to make fractional ownership even more secure, transparent, and accessible, with smart contracts automating ownership verification, rental income distribution, and share transfers. Additionally, the growing trend of global investing will likely see more cross-border fractional platforms, enabling investors to diversify internationally with ease. Regulatory frameworks are also catching up, providing better investor protections and clearer tax guidelines, which will further boost confidence in the space. As real estate prices continue to rise globally, more investors, particularly millennials and Gen Z, will seek out fractional options to enter the market without the burdens of large loans or property management. Institutional investors may also begin to leverage fractional platforms to reach smaller investors, expanding the market's liquidity and maturity. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.